What is the difference between FHA and conventional loans? It's a great question, and just like always, I'm glad you asked. We're going to show you two examples later in the video, one where FHA is likely a benefit to you and one where conventional would certainly be a benefit. If we've never met before, my name is Gavin Sessions with Loans Made Simple. If you're curious to learn about all things related to mortgage and home loans, you're in the right place. Subscribe to our channel. We post new content each week. All right, so let's get that question answered and do a comparison of FHA and conventional home loans. So rather than an exhaustive view of the FHA and conventional guidelines, we're going to highlight some of the key differences that we think you need to know. And we're going to do that by showing you two purchase examples, side-by-side views using FHA and conventional. But before we get to those side-by-side views, I want to highlight three things that won't be mentioned in those examples. So the first is loan limits. So FHA and conventional both have unique loan limits and they vary by regions, right? So higher cost areas in the country have higher loan limits. That's true for both FHA and conventional. So if you're in a situation where you need a larger loan amount, possibly above the FHA loan limit, then conventional is probably the right choice for you. The second thing I want to call out is occupancy limits. So FHA allows for the purchase or refinance of a primary residence only. So if you're looking to purchase an investment property or a second home, conventional would be the right product for you, as conventional allows for primary residence, second home, and investment property. So the third thing I want to mention here is appraisals. So whether FHA or conventional, the primary purpose of an appraisal is to determine the market value of the property relative to comparables. Now, the difference is FHA appraisals generally place more scrutiny on the condition of the property. So again, the purpose of the FHA appraisal is not to give an exhaustive, comprehensive report of the property's condition. That's what a home inspection does. But the FHA appraiser is tasked with noting any health or safety concerns. So think of broken windows, missing shingles, really large cracks in concrete that could create a tripping hazard. If you're going down the stairs and you're missing a railing, or if there's a second-story deck in the back that might be missing a railing, those are all things that an FHA appraiser will likely call out as needing to be repaired prior to closing. So you'd get a value that would be subject to repair of those specific things. Often on conventional appraisals, you don't get that kind of scrutiny. You can still get some subject to repairs, but you're more likely to see those on an FHA appraisal rather than a conventional appraisal. Hopefully that makes sense. All right, so let's jump into our side-by-side comparisons here. The first we're going to see is a minimum down payment of 3%. We're going to show you a view of FHA and conventional side-by-side. All right, so let's start right here at the top. We are looking at a 30-year fixed. We've got conventional here. We've got FHA here. We've got a down payment. We're going to do apples to apples of 3.5% for both. So truthfully, you can have as low as a 3% down payment for conventional, but the minimum for FHA is going to be 3.5%. All right, the next thing we want to talk about here is credit scores. So for conventional, you're going to see your best possible loan terms when you have a credit score of 760 plus. In this example, we're looking for a credit score on conventional of at least 680, likely 680 to 699. And for FHA, we're just usually looking for a minimum of about 620. So this is going to matter as we get a little bit deeper and specifically about mortgage insurance. But for now, let's just keep rolling here. So we're going to use a placeholder purchase price of $430,000, and that's roughly about the national average of a home price in the United States. Our 3.5% down payment here equals $15,050 for both. Like I mentioned before, you can actually have a 3% down payment on conventional, but for the sake of apples to apples, we're trying to make this as similar as possible. All right, so our base loan amounts are going to be $414,950. That's basically our purchase price less our down payment, gives us that base loan amount of $414,950. If we look at conventional here on the left, there are no upfront mortgage insurance fees for conventional, right? For FHA, there actually is here on the right, and that's financed into your loan. It's 1.75%. So if we take that 1.75% and add it to your loan amount here, it gives us a new first loan amount of $422,212, whereas our conventional loan amount did not change, still at $414,950. All right, next thing worth noting here is interest rates. Often we see slightly lower interest rates on FHA. So we're just going to use that as a placeholder here, 6.25 on FHA and 6.5 on conventional. We're going to calculate our principal and interest next. In this case, $2,623 for conventional. That's the $414,950 amortized over 30 years at 6.5%. Over here on FHA, we've got a loan amount of $422,212 amortized over 30 years at an interest rate of 6.25%, $2,600 a month. Just want to pause the video for a quick moment and invite you to connect with us if you're ready to take the next step to get qualified and speak to a mortgage professional, a loan officer, or if you'd like to get connected to a great real estate agent, click the links below. Now we're going to get into monthly mortgage insurance, and this is really where you're going to see the benefit in this case of going FHA. So conventional mortgage insurance is based on credit score, like we talked about up here, as well as loan to value, right? So in this case, we have a credit score of less than 700, and we have a loan to value of 96.5%. And we calculate that by subtracting our down payment from our purchase price, right? So we have a relatively high loan to value and a credit score of less than 700. And that gives us a monthly mortgage insurance rate of 1.2%, which equates to $415 a month. Now, this is where you're really going to see the benefit of FHA, because FHA has a minimum mortgage insurance amount of 0.55%, which is less than half, right? And it doesn't matter what your credit score is as long as you qualify. And it doesn't matter that your down payment is only 3.5%. So in this case, with a minimum down payment and a borrower that has a credit score of less than $700, they're going to see a tremendous savings on their monthly mortgage insurance with FHA. Now, also worth noting here, FHA is a great product, especially for this situation here on the right. But, then the big but, mortgage insurance here with FHA is going to be in place for the life of the loan. So we probably want to think of this loan as a great get-in loan, and that helps the buyer get into the house and start accumulating appreciation, right? So as the home's value appreciates, the loan amount will also be paid down as the buyer makes payments, and the delta between what they owe and what the home is worth becomes equity, right? So as the borrower builds equity, it would probably make sense for them to refinance out of an FHA and likely into a conventional. That, of course, assumes that their credit score is in a place where they could qualify for conventional. So hopefully that makes sense. All right, let's jump in here to property taxes. This is side-by-side, apples to apples. We're assuming about a 1% rate, about $358 a month. And then we've got estimated homeowners insurance here. We're going to assume $1,000 a year, so $83 a month there. So we've got a total monthly payment of $3,479 on conventional. That is us adding our principal and interest here, plus our mortgage insurance there, plus our property taxes here, and our homeowners insurance here. And recall that both these are paid through something called an escrow account, right? So you're going to make this payment of $3,479 every month. Over here on the FHA side, same calculation. We've got $3,231 a month. So that's a pretty substantial difference for most families, $248 more on the conventional side versus $248 less on the FHA side. So if you multiply that by 12 months, that's about a $3,000 impact each year. And if for some reason you bought this house and you never refinanced your loan and you kept it for full 30 years, it equals just about $90,000 of difference. So long story short, for this situation, FHA is the much better choice for this borrower. All right, so now that we've shown you an example of a minimum down payment of 3.5%, let's look at what happens when we increase that down payment to 20%. All right, so same as before, we're going to start at the top here with a 30-year fixed. We've got conventional on the left, same as before, FHA on the right. Down payment this time substantially higher, 20% on both, right? Now, with a 20% down payment, we can actually handle a lower credit score on the conventional side, kind of like we talked about before. And that's because with conventional and a 20% down payment, you're not going to have any mortgage insurance. So we'll get to that here in a second. So on FHA with a 20% down payment, you can also get away with a lower credit score as well. So 620 is a good guideline for us to start. All right, so let's jump back into our example here. Same purchase price, $430,000. 20% down payment on both, $86,000. Base loan amount is going to be the same on both, $344,000. So same as before, no upfront mortgage insurance financed in on the conventional side, and that same 1.75% financed in on the FHA side. We add that in, we keep our loan amount on the conventional side at $344,000. On the FHA side, it increases to $350,020. Same as before, we're going to have a slightly higher interest rate on the conventional side and a slightly lower interest rate on the FHA side. We'll calculate our principal and interest. Again, 30-year amortization, loan amount there, interest rate here, monthly principal and interest, $2,174 on the conventional side. On the FHA side, $2,155. So you're thinking to yourself, FHA looks a little better. Why wouldn't I go that route? Well, this next line is where that's going to change, right? So with a 20% down payment, conventional does not require mortgage insurance. But with a 20% down payment, FHA still does require mortgage insurance. So we've calculated that here at $158 a month. Now, same as before, placeholder property taxes of 1% per year, $358. Estimated homeowners insurance, same as before, about $1,000 a year is $83 a month. So we've got an estimated total monthly payment of about $2,616 on the conventional side, and we've got an estimated monthly payment of about $2,754 on the FHA side. So this is where we're seeing the power of conventional and the opportunity to not have mortgage insurance, right? It's $138 a month savings on the conventional side versus an additional cost of $138 on the FHA side. If we multiply that by 12 months to determine the annual impact, it's about $1,600 savings on the conventional side versus $1,600 of additional cost on the FHA side. Again, not likely, but if you were to hold this loan for a full 30 years, it has about a $50,000 impact one way or the other. So again, conventional with a 20% down payment will allow you to have a lower credit score and also allow you to not have any monthly mortgage insurance. All right, so there you have it. The key differences between FHA and conventional. For those folks with a 20% down payment, we've shown you the power of conventional. And for those with a minimum down payment, it's likely FHA might be the right product for you. So if you'd like to learn more about FHA or conventional home loans, we suggest you watch these videos. FHA here and conventional down here.